Interest-bearing instruments and hybrid instruments. When we're looking at interest-bearing instruments, we're looking at the deductibility in terms of Section 24J of the interest or the inclusion in our income if we are the lender or the holder of the instrument. So the deduction of interest is in terms of Section 24J, and it must be where we are using it in the production of income and carrying on a trade. Then we can get a deduction in terms of Section 24J. However, if we are the holder or the lender, then the interest that we earn will also be included in our gross income, irrespective of the fact that the interest-bearing instrument is capital in nature or not. When you're looking at interest-bearing instruments in terms of Section 24J, it's always a good idea to use a timeline to help you with the accrual periods versus the year-end, where the payment dates do not line up with our year-end. For Level 2 students only, you need to be able to calculate the yield to maturity, and we'll have a quick look at an example of that. Here we have an example. Pause the video and take a look at the example, and then we'll go through the solution. Now you'll notice that this instrument was purchased at a discount, will be redeemed at a premium, and that is part of the reason of why we would have a yield to maturity that will be different to the 6% that we are told in the example itself. You'll need your financial calculator in order to calculate this. We're going to start with the present value, being the discount that we got on the face value of this instrument. The future value will be the premium on top of what the redemption value will be, the 605,000. Our number of periods will be 6 because we are receiving interest every 6 months. And then if you've got an HP calculator, you'll need to put it in as PY for 2. And our payments are 13,750, which is the 5% on the 550,000, which again we divide by 2 because they pay every 6 months. Now you need to compute for I, which is then the yield to maturity, and you'll see that the yield to maturity rate is actually 5.5%. And remember, that yield to maturity of 5.5% is for every payment. So that's not for the year, that's for each payment. Remember, this is only for level 2. Let's go on and have a look at another example for Section 24J. This will be for both levels. Pause the video now and have a look at the example. Remember, there is more on the next slide as well. So they've given us the payment periods, they've given us our year end, they've given us how many installments. There will be, then on the next page, they gave us a breakdown of what the cash cost was, the yield to maturity, so the financing. The amount that's actually being financed will be that 738,000, and what our installments are. So all the information that we need. Now we are being asked to go and calculate the effect on Construct's taxable income. I always find it handy to go and draw out a timeline to make sure that I'm accruing for the right periods in terms of Section 24J. So if we have a look, we'll draw our timeline. The first thing they told us was that we entered into an installment credit agreement on the 1st of August. Our first payment would then be on the 31st of August, on the 31st of October, because we pay every 3 months. They tell us that we brought the asset into use on the 1st of September. That's important because that will determine from when we can start claiming in terms of Section 24J. They tell us our year end is 31 December, and then our second payment would be 31 January. So our year end is important because it falls in between a payment period. We're going to need to go and accrue for that portion that hasn't actually been paid yet. The other thing that's important is because the asset wasn't brought into use, the interest that was incurred for those first 3 months, we cannot claim all that interest in terms of Section 24J. We can only claim the portion from the time that the asset was brought into use up until the first payment. So we'll need to go and apportion it. Remember, Interest accrues on a daily basis, therefore you must use days and not months. So we will account for the interest for those 2 months from the date it was brought into use until the first payment. Then our second interest amount would have been from the 31st of October up until the 31st of January, but our year end falls in the middle there. So again, we now need to go and calculate the accrual for that period between 31st of October and 31st December. And again, we're going to need to use the days to calculate that accrual. Now remember, the question asked us for the implications. Remember, we bought an asset, so don't forget the easy mark of getting the Section 12C deduction. And here's just the 24J that we already had a look at in the timeline. Moving on to Section 24O. So generally, where we have interest that is incurred, where we are using a loan to buy shares, we would not be entitled to the deduction because if you think about local dividends are exempt and therefore not in the production of income. Remember, income is gross income less exempt income. So that's generally why interest on a loan to buy shares would not be deductible. However, Section 24O has come into effect some time ago, but to give some relief, because if you think about it, there are two ways we can buy a business. We could either buy the shares in a business or we could buy the assets in the business. Now, if we buy the shares in the business and we finance it through a loan, it's not deductible. However, if we were to buy the assets out of a business and continue to run that business, we would be entitled to the interest on the loan that we got for the assets. So that's what Section 24O is in essence trying to make provision for. So 24O provides for relief if a company issues, assumes, or uses debt to acquire a controlling interest, directly or indirectly, in an operating company in terms of an acquisition transaction. So there are three important definitions here. A controlling interest, what does that mean? An operating company, what does that mean? And the acquisition transaction. If we have a look at what an acquisition transaction is, we're going to look at where the equity shares were acquired in an operating company, and it was an operating company on the date that those shares were acquired. And after entering into the transaction, the acquiring company is a controlling group company, and the two companies, so both the target and the acquiring company, form part of the same group of companies in terms of the definition in terms of Section 41 of the group of companies. Alternatively, it would also be an acquisition transaction if it is equity shares that are acquired in a controlling group company in relation to an operating company. So this would be, in essence, that indirect. And that must be obviously on the date that the shares are being acquired, that the company is an operating company. Again, this would form part of the same group of companies. And after entering into the transaction, the acquiring company is a controlling group company in relation to the acquired controlling group company, and the two companies form part of the same group. Again, in terms of the Section 41 definition. What is the definition of the operating company? Well, at least 80% of the aggregate amounts received by or accrued that company during the year of assessment must constitute income. So that means gross income less exempt income must be 80%. So in other words, it can't be a company that invests in shares, because then they would have dividends going as gross income, but they would also then be exempted. When we're having a look at this operating company, it would be a company that derives its income from a business carried on continuously, and in the course of which goods or services are provided or rendered by the company for consideration. So that would be an operating company. The determination as to whether the equity shares represent a qualifying interest must be done annually on the following measurement dates. Now, it depends whether or not we still hold the equity instrument or not. So the equity shares, if we are holding them still at year end, will determine whether they are a qualifying interest on year end, so the year end date. The equity shares, if we disposed of them, then we would look at the determination at the date of disposal. Just a note, in terms of the definition of an acquisition transaction, the transaction in terms of which the company acquires equity shares in another company must be with a company that does not form part of the same group of companies as that company. Be sure to work through the examples in Silk to help you better understand it. Section 8F. Interest on hybrid debt instruments that are deemed to be a dividend in specie. So, we need to know what a hybrid debt instrument is, and if we classify something as a hybrid debt instrument for tax purposes, any interest will be deemed to be a dividend in specie and therefore will not be deductible in our taxable income. So a hybrid debt instrument is only an instrument in terms of which a company owes an amount to another person. Can it be a hybrid debt instrument? So there has to be something that is owed. The following instruments are classified as hybrid debt instruments. The company is entitled to or obliged to convert or exchange the instrument or part thereof in any year of assessment for shares. However, what will not be a hybrid debt instrument is where a debt instrument is exchanged for shares at the market value of the shares is equal to the amount owed, because then that would just literally be a swap of the debt instrument now for equity instruments. We're talking about where there is an obligation to convert. So it could be that there are a set amount of shares that it would convert into, regardless of what the market value is of the shares at that time where that instrument, that debt instrument, is converted. The next one is that the obligation to pay has been deferred as the obligation is conditional upon the market value of the assets of the company being greater than the liabilities of the company. Or as we've stated it here, that the market value of the assets of the company cannot be less than the amount of the liability. So it's a solvency. The third criteria that could make something a hybrid debt instrument, is where a company owes an amount to a connected person and has no obligation to repay that within 30 years of the issuance of that instrument. We count the 30 years from the date that that liability came into existence. If there is a debt instrument that is repayable on demand, so there isn't a repayment term necessarily, so it's not repayable in any specific period. However, in terms of the instrument, it can be repayable on demand. That would not qualify as a hybrid debt instrument, and therefore it would not be seen as a dividend in specie. So what are the effects of Section 8F for the company paying the interest and for the company receiving the interest? For the company paying the interest paid is deemed to be a dividend paid, therefore no deduction is allowed in terms of Section 8F2B. For the company receiving the interest, the holder of the instrument, they would see that interest would be deemed to be a dividend received. It would be included in their gross income in terms of Section 8F2A. And then they would get the dividend exemption in terms of Section 10(1)(KI). So that's just important to note, is that the company that is paying the interest will not get the deduction, and the company that is receiving the interest will include it in their gross income, but as a dividend, and then get the dividend exemption.